Hello, everyone. Today is Friday, May 6th, 2022. My name is Evan. Welcome back to the Trade Risks weekly stock market analysis video series. If you're brand new here, welcome. Thanks for joining us. Here's how this video works. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets. We go beyond price action and we pick apart things that look interesting or notable, from interest rates to market internals and volatility and sectors and all the good stuff. And then in part two, we jump into the charts. We look at those longer term trends. We analyze price action. We've got a couple of key charts we're going to be looking at in the treasury market. We've got oil we want to look at this week. We've got the dollar we're going to look at, natural gas. So we've got plenty to talk about. Let's jump into some of the headlines and takeaways from this extremely volatile week. And really, it was turnaround Thursday. So we always hear turnaround Tuesday is the old saying in the market, but turnaround Thursday is what we got this week. So remember, we had the Fed out, we had Fed statements out. We've got a little more clarity about just what their thoughts are, what their policy is, and how they're going to be sort of maneuvering those short-term interest rates. And we saw that initial reaction to the upside. We had a very large rally post Fed speak on Wednesday. And then Thursday, you get the exact opposite behavior sort of follow up that day. Instead of getting follow through to the upside, instead of getting the the structure being built in the market and those lows holding, we got the exact opposite that happened. We totally gave back all of the gains and then some from Wednesday. We had some of the biggest single session down days we've seen since the COVID pandemic over a year ago at this point, and markets sort of cratered to new lows. Friday, very volatile session again, but some losses, nowhere near as big as Thursday. And generally speaking, the markets all finished lower on the week. We saw, of course, on Thursday, the other behavior playing out was interest rates ripping to the upside. So it's funny because last week we had this slight pause. We had this as a note saying, wow, interest rates finally stopped just skyrocketing to the upside. Is this where we're finally going to see the market kind of stabilize, maybe pull back a little bit in terms of interest rates? Nope, that was the exact opposite. It turned into a continuation pattern for all you technical traders. We saw interest rates rip to the upside. And as we continue to be reminded, cash remains king. Let's take a look at some of the performance here from this week. So in the right-hand column here, you can see it was, again, a down session across the board. Nothing extreme. The real carnage this week was just, again, that turnaround Thursday. We were up 3-4% on Wednesday. It was looking to be like a nice recovery week, and then suddenly we gave it all back and finished in the red here. The Nasdaq and the Russell 2000 were hit the hardest. If we take a look at our long-term trends here, okay, so not much has changed. The market continued lower this week. We've basically been in sell signals here across our smart trend filter indicator. So this is just a simple indicator that we've built out that measures price and volume across time. And you can see the S&P 500 finally transitioned down back to a fresh sell signal this week. Everything else has basically been here, and the prior signal for the S&P 500 was down as well. So life is still pretty tough here. For the bulls right now, they cannot find some solid ground to stand against. If we take a look under the hood of the market, so we look at market internals, you can see basically the broad-based selling is also occurring still. So it's not just the mega caps that are leading us down. We continue to see more stocks expand to the downside here and make 52-week lows. You can see the AD line was quite negative this week, and you can see the percentage of stocks over 20 SMA in the S&P 500 are about 20% right now. If we look at those 52-week highs minus lows in aggregate here over the past 30 days, you can see this is the trend. So this is what's happening underneath the hood, is you're still seeing expansion in the selling pressure here across stocks. Now, Now, again, one of the things we talked about last week, and I'm going to just say it again this week because I still believe it's true, the only thing that is bullish right now is that everything looks so horrible, right? Everything is so bad across the board that it, weirdly enough, becomes a positive thing, a potentially positive thing, right? And we're going to talk more about that a little bit later. This chart is obviously horrendous and continues to be that way. If we take a look at volatility, I guess there's some improvement here. So I guess not everything got worse this week. We did see some improvement in the VIX. So the blue line is this month's VIX term structure. Last week's was orange. And you can see orange, we had the backwardation last week. We might still be close on backwardation. I take this reading here using something that could be a little more precise. So I'll have to look at what the real numbers are. This is still an unhealthy looking term structure for volatility. It still shows you that fear is out there in the market, but it does look like the front month has come down quite a bit. It's down around 30 here. Markets are at lows. VIX is at 30. That's at least some relative performance there, right? Some relative maybe sunshine in the horizon, in the forecast, but still, really yet to be seen. If we take a look at sector performance, again, we had a lot of things green this week, or at least some things green, mostly from energy. So energy had an extremely large rebound this week, 10% to the upside. In fact, broke out to new highs. So you got new 52-week highs, new multi-week highs, new multi-year highs for energy this week. That was nice to see. Utilities up 1.33%, financials up 0.64%, communication services and industrials also in the green. In terms of what was red, real estate continues to really kind of fall off a cliff here. It's seen a pretty strong reversal over the past 2 weeks, basically back to back now, and it's down 10% over the past 1 month. If we take a look here at interest rates, so this is the painful point here. We saw yields right across the curve here, right across the maturities, all just jumping pretty violently, especially the 30-year yield was up almost 10% this week. That's a very big number. And that, just continues to put pressure on lots of areas of the market. We did see the investment grade proxy here and high yields also down this week as well, in line with the market, sort of what you might expect. In terms of commodities, so we saw the dollar up 0.5% this week. So again, the only thing that's safe right now is the US dollar. That's been a good place to hang out. Gold was down a bit, certainly fared better than a lot of other things, but still not really giving you that safety haven status. Silver, Bitcoin, ag was down, but crude oil, natural gas, we're going to talk more about those in the second half of this video, both up pretty brightly this week, 6 and 10% respectively. Last but not least, correlations here, not a whole lot changed. I mean, basically, you're still seeing a very sort of what you'd expect in a very risk-off, sort of highly volatile market environment. You're seeing strong correlations, lots of bright green and red here in all the areas that we've been talking about over the past weeks. Inverse dollar correlation and strong risk asset correlation. If we look at our trading systems here, so this is how we're positioned. We've got 2 trading systems that we run here at the Trade Risk. We've got our Merlin trading strategy. This is a top system here. It's 18.44% invested, 3 positions on. One of those is gold. So needless to say, pretty defensive and pretty cash heavy. And then our short-term trading system down here, Lamerick, this is a very tactical swing trading strategy, is 100% cash. It has no positions on. It had no positions on Thursday, thankfully, either. It did actually try and get some shorts filled on Thursday. That did not happen, though. Just market moved too fast lower, and basically just sat here in cash, which, given the alternative, wasn't a horrible thing. So that's how we're positioned heading into next week. These are trading systems that we publish nightly trade reports for. They're fully rules-based, fully quantitative. They run without me, and they make decisions based on real market research. So if you think they could be helpful for you, check out the $1 trial. Should be appearing in the top right of your screen, or head to thetraderisk.com/trial. See if they're a good fit for you. And with that, we'll be back here in just a second with part 2. All right, we are back here with TC2000 Open, and we're going to start off with some price action analysis on the S&P 500. So this is the S&P weekly chart, cash settled market, and we're looking at our very simplified, our simple roadmap, our simple view here that we've been analyzing price action with over the past couple of weeks. We've got basically two key areas here. We've got the 4,600 zone in the S&P 500, which acted as resistance twice this year. And then we've got the lower zone around 4,200 down to about 4,180. This has been the broad goalpost that we've been keeping an eye on this year. And so when we look at the price action last week, we had our first confirmed close below this prior support zone. And this week, we did it again. We basically got a second continuation close below this zone. So my point of view, my perspective on this market, given the last 2 weeks that have unfolded here, is that we need to be extremely cautious as the market is below 4,200. I see nothing but bad things happening while the market is under this zone. We can easily cascade lower here, back down into even the 3,000 handle for the S&P 500. As long as we're below here, I think you need to be very cautious on this market. Now, what is the other side here? What gives us some hope? What can change that? Well, what can change that is of course, a move back over 4,200 and actually holding above there. So if we go to a daily chart, we had that starting to happen on Wednesday. Wednesday was a very constructive looking single day that happened here in the market. And, after Wednesday's action, what you just wanted to see was the market hang in above here, right? Even sideways is fine, but don't give it all back, right? Don't fall back below the 4,200 zone. But we didn't get that, right? So Wednesday was a good, start position on the long side, but then you had to adjust on Thursday. And obviously this is easy to say in hindsight, but this was what we were looking for, a thrust over 4,200. The problem is that thrust did not hold and we're back below it. So when I look at this market, again, I want to see us back over 4,200. I want to see us holding above 4,200, and that will start to get me off of the bear side of this market. But so long as we are hanging out below these levels, risk is to the downside. We have to be careful. And so that's really, the big takeaway here. We can do a lot of other fancy analysis and basically conclude that same thing. We are oversold on lots of different metrics, but again, I don't know that means a whole lot. We are, let's say, back to the weekly chart, down 5 weeks in a row. So again, we've covered a lot of ground to the downside. Sentiment's horrible. There's lots of fear in the market. There's a lot of things that look horrible. And back to what we had said earlier, the best bullish kind of evidence right now is that everything looks horrible, and therefore the contrarian play might be to look for that bounce. You just need to see if you can get that confirmation. You just need to see, keep an open mind, and if price can actually do it. So as a trader, you can be looking for that thrust higher, but it needs to actually occur. It needs to actually take place. I would not be just trying to buy blindly down here without a plan, without a stop, without risk management, et cetera, et cetera. So that's really the take here on the S&P 500. I don't think we need to go too much more in depth than that. And really, all of these markets all sort of fall into that same line of thinking. It's these big levels that we've been talking about here. So 188 is what we've been essentially saying is the line in the sand for the Russell 2000. That's what we need to see the market stay above. We're below it. We're 6 points below it. We tried to get above it earlier in the week. We failed to stay above it. And now we're back, down around 182. So for me, again, path of least resistance, and the risk is very much to the downside. We are oversold. We are beaten up. Sentiment's horrible, but until and if we can start to put in a rally and hold and get back over 188, I would not want to be, pressing that or getting too aggressive down here until we can see that reversal start to take shape. And the Nasdaq 100, again, very, very similar comments here. We're basically looking at around 320 here as the line in the sand for the Nasdaq 100. So again, until and if this can start to reclaim this zone in here, that's what I'd be wanting to pay attention to. Note, we did have some extremely high volume this week. So take a look at the Nasdaq 100, take a look at the IWM, right? Back-to-back very, very heavy volume. Take a look at the S&P 500, extreme high volume this week. So there are signs that maybe we are capitulating and washing out. Let's just, get that move started before we do too much else. So hopefully that's clear. Hopefully that's helpful. That's really, kind of the most interesting thing I can say about the overall broad market action. If we take a look at something like the IEF, this is the 10-year Treasury bond. So this is the inverse to the yields, right? So if you want to take a look at yields, we can look at the TNX. And this is interest rates. This is the 10-year Treasury yield, and it's just ripping to the upside non-stop. So this needs to cool off. If we want to see the market start to stabilize, we really want to see these yields calm down. Take a look at TLT. Again, extremely heavy volume coming in. This is getting quite vertical to the downside. It seems like we might be in the washout phase, but I've probably said that now multiple times this year, and this trend is just still strong to the downside. So we're not seeing any let up here. We had that brief let up last week, and then it quickly just resolved itself lower. So Treasury market, there you go. If we take a look at oil, oil's quite interesting here. So if we take a look at oil, we've been noting this consolidation that it's been in for the past 3 months now. So you can see very cleanly here, it's a very nice technical structured pattern. It's got a lot of very well-defined levels here. We're basically closing, as we did on Friday here, we basically closed at new 1-month highs, 30-day highs for USO. So that is constructive. We're at the top of the range. Let's see if we can break out. Let's see if we can continue. We saw volume dry up over the past month and a half, and we'll see if we can get some type of breakout confirmation here next week. So something to pay attention to. It's coiled. It's in an uptrend. Let's pay very close attention next week. Natural gas also continuing higher this week. It was up 10%. So you can see this runaway trend to the upside has also now been continuing. It did have a bit of a strong reversal here on Friday. It's incredible that this is an 8% down session, but it doesn't even look that extreme, just given how much ground this is covered, given how much volatility is baked into the UNG ETF here. So we did get a bit of a thrust lower. We did lose this high right in here. So I'm not totally in love with trying to just buy this blindly right here. This might need to come down and settle up. So I'd be a little bit cautious here in the short term if you're playing this, but generally speaking here, the trend very much still to the upside. But I wouldn't be surprised if this cooled off back down into the mid 20s, even potentially even back down to the 23 zone. So that's really my thoughts there on commodities and the dollar. Let's finish this off with some sector and industry of notable movement. So this is a TC2000 layout. If you're a user of TC2000, you can get this layout on your platform. It's listed on our website in our TC2000 store. But if we take a look at things that were working this week, so they're pretty short list. There were six industries, 6 sectors that really started to, separate themselves this week. Medical distribution. So take a look at the heavy volume and this big, bullish pullback. And resumption of this trend. You can see this is quite interesting there. We've got oil and gas E&P. So remember, oil and gas, the sector was up basically 10%, or energy, the sector was up about 10% this week. So we're seeing a lot of these individual specific industries also performing well. So we've got oil and gas integrated here at new highs, refining at new highs as well. We've got XLU, which had this very high volume turnaround this week, which was nice to see. And then again, XLE breaking out to those new highs. On the downside, there was, good amount here to the lower, to new lows or heavy volume to new lows. So we see beverages, we've got industrial business services specifically, education and training services. This continues to just fall off a cliff here. Financial data and stock exchanges, seeing some very heavy volume as it breaks to new multi-month lows. Footwear and accessories, new lows. Grocery stores pulling back and making new lows. Metals and minerals also pulling back, not heavy volume, but still kind of just settling back in. We got leisure, luxury goods, medical devices, personal services, publishing, and then we got a bunch of real estate all to the downside. Remember, real estate's been getting hammered here the past couple of weeks, so we're seeing lots of continuation to the downside in that area of the market. We also see restaurants and then some regulated water utilities, followed by the sectors of real estate, technology, and consumer discretionary making new multi-month lows. So that's what's on the list. That's what's moving underneath the hood in terms of the more specific front of industries. Hopefully you find that helpful. Hopefully you managed this week okay. It was a very, very tricky week out there. You had to be nimble. Hopefully everyone has been managing risk okay and has been surviving through these very, very volatile markets. Keep an open mind. Next week we are, again, sentiment's lousy. We are oversold, but let's wait and see if we can actually start to structure a bounce before you go to, jumping in too aggressively. So that's all I've got. Let me know what your thoughts are this week as you digest this week. Leave a comment below. Love to hear it. As always, thank you so much for tuning in. Every Friday we do these long form videos, and you can subscribe to our YouTube channel or follow us at thetraderisk.com to stay up to date. Thanks so much. Have a great weekend. We'll see you back here next week.